I'm 24 with $185,000 in an individual brokerage account for my stock portfolio, and I'm going to show you everything that I'm going to do by the end of this year to make sure that I am best aligned to grow this portfolio to a $250,000 plus portfolio in the future. I'm going to take you through my investing philosophy, my mind, and everything that I want to do and plan to do in order to grow this money. So make sure that you stick around to the end of the video because there's going to be some gems dropped throughout the entire video. And if you guys could just subscribe to the channel because it helps out so much. Thank you. Let's get right into it. Now we're going to go through nonetheless this $185,000 portfolio as advertised here. This is a portfolio that is mainly made up of stocks, some other ETFs, but we're going to go through each position, why I hold it, what I'm planning to do, and what kind of makes up this portfolio here. So this portfolio year to date, we are up 30%, 29%, be fair, 29%. Given the S&P 500, this is the benchmark that we probably want to compare ourselves to as it is the market average. If you were to buy the S&P 500, this is what you would get on average. An average person would get this kind of return. So we are almost doubling that average, which is pretty good year to date. As for the 1 year, we have about a 37% return, given that we are kind of a little bit outperforming the S&P, which is a good sign. In these really good years, you want to be outperforming if you can. I'm going to pull your attention over to this asset allocation area here. We have majority domestic stocks, short-term stocks. These are stocks that anything of less than a year that we are holding. And other, this is our ETF position in something spectacular that I'll get into right now. All right, if I could pull your attention here, we have about 185,000 in this account with 46% in gains for the total gain loss that we have and $49,000 of gains just from a couple positions, which is pretty, I would say pretty good so far. So far, it's been a good year. I can't complain. This has been an amazing year for anybody, for me, of course, as well. But let's get right into which positions I'm holding and why and what I believe is going to happen. All right, so we have this $29,000 in cash here. I'm going to get into this a little bit later, but this is essentially holding it for any position that I want to buy more stocks in. So anything, just having it on the side, dry powder, when an opportunity arises, I want to deploy more cash in there to increase these positions and get more dollars in the future. Okay, that is my goal, and I'm gonna make it happen. Going first, number one is AMD Advanced Micro Devices. So far, we have about $73,000 in this account with 105% in gains. I remember buying this when it was just a baby, and when I say a baby, I mean 4 months ago. Okay, maybe not 4 months ago, but it was really low in April, and we were buying it all the way up until 110, 120 bucks. This company, we have an average cost basis of $113, which is extremely cheap relative to where it is now. If you were to look at the valuation of where AMD was trading back then, you would be astounded, right? Like there was a super high PE at the time, but you would have to look into it because it was due to the Xilinx acquisition that they're taking a accounting loss on the books. But realistically, if you look forward, it was only like 25. Super not super expensive, and that totally makes sense. A price to earnings ratio of anywhere between 25 on a forward basis is not bad for a company that is really growing quickly. And when I say quickly, I mean like 20+%. This company is growing at 27% every single year when it comes to revenue growth, and their earnings are growing 100%. Just think about it like that. Like that is a company growing insanely fast. You have Advanced Money Doubler, which is a company driven by Lisa Su. Lisa Su is one of the best, one of the top tier CEOs in the world that you can ever get. They operate in a duopoly pretty much, where you're essentially, as a consumer or a enterprise customer, you're looking between AMD or NVIDIA. Those are the two options that you're pretty much going to get unless Google rolls out their TPU chip. But even then, right now, your two really options are just AMD, NVIDIA. That's all you're able to get. If you want to build a PC for yourself, that's the two graphics cards that you're going to use. If you want to build a CPU or a computer and have a CPU, you're going to either go with Intel or AMD. So they pretty much operate in these duopolies, and they are gaining market share in those areas. But majority of it is driven by data center growth, which has been the story for this company over and over. They have companies like the Amazons, the Googles, the Metas that are coming to them to buy chips because AMD's demand isn't going to be fulfilled if you're a new customer. New customers are coming to AMD because they have, one, they can fulfill the demand. for who knows how long, we'll see. But two, you come to AMD because of the price to performance. That is what drawed me to AMD as a customer when trying to build a client, not a client, but a PC for my brother. When trying to build a PC for my brother, it was deciding between Intel, AMD. I always go with AMD because one, at the time, CPUs for Intel weren't the best. They would fry every single component, and that scared me and a lot of people from buying Intel. Plus, AMD came out with AM5, which is the entire new upgrade route to modify your PC later on. AM4 was like the older, think about it as like a latest generation, like a later generation, where if you have AM5, now you're able to like add new things to your computer. Think of it like iPhone's MagSafe. Before, phones didn't have MagSafe. Now you have MagSafe. And now you're able to get the accessories with MagSafe. Now you're able to get the charging that comes with MagSafe and like the wallets, and as well as like the sticky stuff on the back of the MagSafe. All of this accessories, add-ons, upgrades to your phone that you would have never gotten before if you did not have MagSafe. Exactly like that for AM5, AM4. So I like AMD. This is a company that has been growing, and I intend for this company to keep growing in the future. I want to hold this company until the day that it doesn't make sense to. But for now, this is a hold for me, and I don't think I want to add. Not that I don't want to add, because like if it did drop low enough, maybe I would. But I'm so heavily into this stock where this is about 40% of the entire account that if I add more, do I take on too much concentration risk? Possibly. So I do want to diversify this portfolio a little bit more, but other than that, I am pretty confident in the position, and I do want to hold it for a long time to come. Next, we have Crocs. Crocs is a company that we are down about 9.5% on. This is 21,000 buckarooskies. It has not been the best so far for Crocs shareholders. I will tell you that because one, we have Trump's tariffs. Trump's tariffs are putting a lot of pressure on Crocs. We know, if you guys follow Crocs, they actually get 50% of their revenues from Asia. When you have 50% of your revenues coming from Asia, you probably damn worried about some tariffs, okay? So, given that there's been a lot of tariff uncertainty, tariff risk, Crocs hasn't been moving. They are a free cash flow generating beast. I believe so far in the past 3 quarters, it has been $700 million of free cash flow. I intend for them to do $1 billion plus of free cash flow this year alone. And they're only a $4 billion market capitalization. It is an insanely small company for the amount of money that they are bringing in. It comes from their gross margins that come from cross-light material. They're able to get like 60% margins by selling these rubberish shoes for really expensive on the dollar. If you actually go buy a new pair of Crocs, you're probably gonna drop anywhere between $50 to $60 on average. But the moat here with the company like this, like usually people stay away from fashion or any kind of apparels or wearables, strictly because one, fashion comes in and out. It's really quick. It really comes in and out. But I truly believe that Crocs has a moat where they're actually able to sustain their business due to the uniqueness of having a wide shoe that people like. There's so many wide shoes, right? But it's the customization and the easeability to wear it out. If I want to have kids and get them out of the house to go run errands because we're going to go to the park or something, let's go throw on Crocs. We're going to go on a walk. Let's go throw on Crocs, right? It makes it easy for the parent-child relationship. If you have kids, you know how hard it is to put on those shoes. And not that I'm a parent, but I can only imagine. But I have cousins that I've tried to put on shoes before for when they're little kids, and it is not the easiest. I will tell you that. Having Crocs makes it a lot easier. And you also have the partnerships. You have NFL partnership, you have Disney partnerships, you have Pokemon partnerships. All of these partnerships get the kids to want to buy these Crocs. Add on the Gibbets, which is another small piece of the business, but growing nonetheless. And I think they actually have something going for them. If you know Hey Dude is actually part of Crocs too. It hasn't been doing well for them at all. They probably lose about 20% every single year on Hey Dude business. Not the best, but the profits from Crocs are able to sustain the losses of Hey Dude, where I'm not too worried. I do want to hold this for another couple of quarters and see where they can actually drive this going forward. I do have a 20% stop loss on this, saying that like, hey, if I get minus 20%, maybe I'm wrong. Maybe it doesn't make sense to hold Crocs, and I'd be better off throwing it into big tech like the next couple of companies. So getting into the next company, we have Google. Google has been one heck of a story in the past year. Google has been a company where we're up 56% and have about 26,000 buckarooskies in here. Nobody wanted this stock a year ago, the beginning of the year. Nobody wanted this company when it was trading at $150 a share. This is Google. This is a company that you're watching this video on. YouTube is owned by Google. This is a company that has Waymo, that has self-driving cars that are soon to beat Elon Musk's Tesla's self-driving robotaxi. This is a company that you are using your default search engine on. This is a company that owns Gemini, that has AI capabilities that are going to compete with ChatGPT, if not are even better. So you have a company that is one of the best world-class companies in the world, growing revenues at 13%. This is a company that most people use on their day-to-day and they don't even know it. This is a great company that has massive growth back then at a very great price. Like back then it was $150. It was a no-brainer to buy the stock. Now it is $253. Now you think about it. This is a company that is trading about at 25 price to earnings ratio. That means their market cap divided by their net income is going to get you that 25. It's one of the cheaper companies in the Magnificent Seven, Magnificent Seven being the biggest 7 companies in the world. I like Google. This is a company that I think is going to compound and earn me a return of like 15% every single year. I wouldn't be surprised if I'm able to get that from Google, that is a low risk, one of the better plays. They are very financially sound, do not have too much debt, and can cover their liabilities in an instant, where you don't have to worry about this company going belly under, because they are one of the best in world class when it comes to their balance sheet. Their balance sheet is insanely great. That is a company that I do want to hold forever. I don't know. I think I do want to add more to this position, but I do have other positions that I want to focus on first before Google, given that this position is about a 14% allocation in this portfolio. So getting to the next position, which is PayPal. This is a company driven by Alex Chriss, the new CEO that came in maybe 1 or 2 years ago. He came from Intuit. He is trying to turn around this business. This business was trading at $300 plus a share. Today, it is at $67. I remember buying this company when it's about the same price as it is now, and I've been holding it for the past 2 years. So in the past 2 years, we've probably gotten a 10% return. This is abysmal for any company to get a 10% return in 2 years. This has been an underperformer for us, and to say nonetheless. And I wish that I would have been more diligent to find a better opportunity for this money. But nonetheless, it is a company that we have not lost money on. So can we be upset? Yes, we can, because the market has done so well if we had made better decisions. But that is okay. Nobody ever went broke by making money on stocks. Something like that. But yeah, this is a $16,000 position, about 9% of the portfolio. We're up about 10% on this. And PayPal is one of those extremely cheap companies on a valuation basis. Yeah, so this company is actually trading at $64 billion here, and it is, to say nonetheless, a steady grower for us. It is free cash flow generating beast. Even though it has dropped down a little bit, they are buying back their shares insanely quickly at 7% clip every single year. That's a lot of shares getting returned back to shareholders. And free cash flow of $5.3 billion, given that they are a $60 billion company. That's a lot of free cash flows that they are generating. That is an insane amount. Their free cash flow yield is about 8% here. Now, PayPal for me is going to be a hold. I do not want to add more to this, given that it is already 9% of the portfolio. This is one that I believe they could turn around in the next couple of quarters or years. But for now, I will hold this because there's a lot of competition when it comes to the space. I truly believe that when it comes to a superior product of money transfers, it's Zelle that takes the cake. But I don't really think you're buying PayPal solely just off peer-to-peer transactions. It's more of the advertising that can come with PayPal, targeted ads for people that, they know what they want to buy. And we know that the ad space is extremely lucrative. Most people that go into the ad space come out with making 80% margins. So I want to see where Alex Chris brings the ad business of PayPal and where it goes from there. Nonetheless, they get plenty of transactional volume when it comes to their PayPal as well as their Venmo. They also have Braintree, which is another business, which is a integration for buying things online where you're able to have that PayPal, pay with PayPal partner. Log in and pay for your stuff with your credit cards already linked. There's also buy now, pay later, but that I believe is a predatory business that nobody really should be paying for. I don't really think that PayPal has the extreme moat, which is why I don't want to add more to this. This is more of like a valuation play to turn around this company and then funnel this into other profits, funnel the profits into other businesses, I mean. And once that happens, hopefully sooner than later, then we can throw this into a better position. And if not, it'll be what it is. And it's a company that's going to return me 7% by just buying back their shares and growing steadily and being however it is today, which is okay. It's more of a hedge for inflation at this point to own PayPal stock because it hasn't moved and it hasn't gotten like insanely returns on their capital that they're putting out there to like turn around the business that quickly. We're gonna have to see what happens, but for most people, this is a store value to hedge against inflation and get that like 7% return. Okay, the next one. I'm excited about this one. This is Amazon. Amazon is a company that we have about $10,000 in, and we're down about 2.5% on this. This is a company that I do want to buy so much more. Amazon. If you were to go back in history and ask yourself, would I buy Amazon back then? You would probably say yes today. You probably ask yourself, do I have an Amazon account for Prime? You probably say yes today. Do you watch Twitch? Yes, you probably maybe or not. But if you do, Twitch is also owned by Amazon. If you guys shop at Whole Foods is owned by Amazon. Amazon owns a lot of things. They have their self-driving business called Zoox, which has rolled out in Las Vegas. If you guys live in Las Vegas, let me know how Zoox are because I do want to ride one of those one day. I think Zoox is so awesome. You could sit across your friends and blast music and just imagine going out and you are sitting across your friends and just hanging out instead of sitting face to face with a seat that is empty, looking at the back of it and talking to an Uber driver. Like this is going to be a way to change and have a more social way of living life. Hopefully it is cheaper than Waymo or any Uber. I think it's probably comparable with Waymo, but hopefully it's cheaper than Uber's because then you wouldn't have to like pay for tips and stuff. But I get it. People got to make their money. But I do like Zoox. I think the idea of it is so awesome. And I do want to but I do want to ride in one day. Okay, Amazon. If I pull up a chart here. So Amazon is a company that is trading at a 31 price to earnings ratio with a growth of revenue of about 11% a year. Free cash flows have been dropping because they've been investing so deeply into their infrastructure here. The capital expenditures have been picking up from $93 billion to $108 billion. Their shares, they're not really diluting, which is okay. They're just funneling all of their money back into the business, which is the exact thing that you would want a growth company to do. If you want a dividend company, you're going to want them to return that in the form of a dividend back to shareholders. But this is a growth company. We want them to actually return their money back to us by throwing money into the fire pit of AI, data center, cloud computing, all of that stuff. Invest in all of these things to get a return to one day give it back to us. I think Amazon is going to be a company that is going to be valued a lot more in the future. This is just my opinion. I do think that Amazon does trade at an operating cash flow that is pretty cheap throughout its historical. So it's about 18 today. And if you were to go back, this is pretty average for where the company has been trading. If you look at 2023, we're pretty much in standard in line with where it's been trading. So Nonetheless, that is a good sign. But where has the stock price gone up in the past 5 years? In 2023, we are up almost $50 a share since then, right? So this has dropped from their extreme high in 2022 of 43 for operating cash flows, and it's coming down to a more attractive valuation. This, I believe, is buying a quality company at a fair price. I don't think we're getting an exact steal today where it's like you are getting a steal and it is a fire sale, and if you don't buy 10 of these, then yeah, it's, I believe, a fair price for Amazon, given that Amazon always trades at a premium. If you guys follow Amazon, you know that Amazon always trades at a premium. So nonetheless, Amazon is a company that I want to own for a very long time, and this is like a retirement position account for me. And unless Amazon detrimentally changes their business, I think it is one of the safer companies that I will be holding in this portfolio. The last position here is just Bitcoin ETFs. This is a Grayscale Bitcoin Trust. Don't ask me if I know whether this is going to be better than IBIT. Nor have I done the research to really care about that. I've just been holding this ever since 2021. This is a Bitcoin ETF that I just wanted to hold called Grayscale. We are about $7,000 into this position, and it is about a 92%, 95% gain for us. They kind of split out here. It's the same holding, essentially. They just kind of split out into two different tickers here, but nonetheless, this is a small position in Bitcoin of about 3% of the portfolio. I'm okay with holding a position this large, this small, actually, because I'd rather be a part of it than not be a part of it. And Bitcoin is one of those things where it's like, hey, you never know where it's going to go. And it's such a small position that I figured, why not? At my age of 24, this is exactly what I want, to take on this risk. If it goes to zero, it goes to zero. If not, maybe we make money. Maybe, just maybe. And if it does, if we do, that's okay, because I'm okay with that. Okay, now I want to go back to this cash position here of $29,000. This cash position, I really want to deploy this in a mix of two different companies, right? It's going to be a mix between Amazon. I want to throw like half of this into Amazon, or maybe like 2/3 of this into Amazon. And the other portion, I really want to buy Meta. Meta, like the company that owns Instagram, WhatsApp, Oculus, Reality Labs, all of that. That is a company that is owned by Mark Zuckerberg, formerly known as Facebook. And that's a company that's trading at the same valuation as Google and also growing a lot quicker. Like Google's revenue growth is 13%. Meta is growing at 19%. And I do think that Meta has such a great business. They do so well of copying other businesses like Snapchat. If you had stories, Snapchat stories went over to Instagram. And then now you had TikTok. So TikTok Reels went viral. So nonetheless, it is a corporation where they're capitalizing. They're not reinventing the wheel. They're just taking what's out there, redeploying it for their monthly active users that are in the millions, and just monetizing off there through ads. And ads are very lucrative in this world. So I want to own Meta, I want to own Amazon, and these are companies that I'm going to be adding to. I do have some buy prices that I do have orders for. And if it does hit those prices, I will be purchasing a lot of Amazon and a lot of Meta. So I'm hoping that this week or next week, we do get a red market. And I'm hoping that we do. If we do, we will be okay. We will come out victorious. And I truly believe that. I think that in 5 to 10 years, this portfolio will be higher than it is today. By the end of the year, not the end of the year, by the end of next year, I'm hoping that this turns into a $250,000 portfolio just through the money that we're able to add through here, through day jobs and all the money that comes into bank account, funnel into here, as well as gains. I am very, very, very excited about AMD, where this is going to go in the next 12 to 24 months. It is going to be a roller coaster. I have so much money into this. It's going to be so exciting. And all the money that I plan to throw into here is going to come from my day job as an analyst. So not stay strapped, but stick around for the ride and make sure that you guys are following along, because this is going to be so exciting. If you guys made it to this point of the video, thank you guys so much for watching. We are growing so fast, and make sure that you guys subscribe to the channel because it is going to be amazing. Thank you guys so much. Peace out.